What's going on, guys? It's Henry. I have specific trades on spreads that I'm going to do long and short positions on. So this is going to be a very interesting video. I'm going to be trading Apple, Facebook, and Google. In this video, I'm going to have 3 different spreads. I'm going to explain how I'm doing them and why I'm doing them. I got this idea from a recent video that I was watching, and I want you to check it out as well before I get into trading.
Tell it to our broader audience. You actually call Apple, quote, the most overpriced tech stock that exists. Tell us why.
Yeah, I mean, in terms of big cap tech, it clearly is in my mind, because if you look at it in terms of how much they're growing relative to the multiple, it just doesn't make any sense, right, relative to the other mega caps. So Apple's revenues compounded over the last 5 years, including this calendar year, because we only have about a quarter left, is growing about 11%. Microsoft is growing about 15% over this time. Google's at 23, Netflix is at 27. Amazon's at 28, and Facebook, given all the discussion about the metaverse, they've grown revenues compounded at 34%. Well, you can buy both Facebook and Google at a lower multiple than Apple. And don't forget, Apple's a massive pandemic beneficiary. And so for them, their iPhone revenues over the last 5 years, fiscal 15 to fiscal 20, were down 11% over 5 years before you had this pandemic benefit. iPad, Mac sales were also down year over year before the pandemic hit. So, for me, we like Facebook a lot. We like Google a lot. They're growing 2 to 3 times faster, and you can buy them at a lower multiple, but with faster growth rates in the future. And we haven't even gotten into the risks around privacy and what that does to their app store take rates.
All right, guys, so after watching that clip, I realized that man is correct, that Apple does have some stretch valuations, and they did have some significant benefits from the pandemic that I don't think they can sustain, or at least looking at the 3-month chart, the stock is up 2.71%. But looking at the 1 year, it's up 32%. And I don't think Apple necessarily deserves to be the most expensive stock on the market right now at a valuation of $2.5 trillion. So the thing is, I don't know for sure if Apple is overvalued, but what I want to do is similar to a hedge fund. I want to go long in short relative ideas. So for Apple, what that means is I'm going to be selling call credit spreads. And for Facebook and Google, I'm going to be buying bull call spreads, betting that both of them will rise. All right, so what I did right now is I opened up Apple, Google, and Facebook in Yahoo Finance. And what I'm specifically looking at is the different metrics like price to sales, price to earnings, market cap, of course, at $2.5 trillion, which is pretty high. It's actually the highest market cap stock on the market right now. And I'm also going to scroll down right here. There's quarterly revenue growth. So quarterly revenue growth for Apple is 28%, which is no joke. It's pretty high. But if we look at Google, Google is more reasonably priced in terms of market cap. Google has 41% quarterly year over year growth. So that's going to be higher than Apple. And then looking over at Facebook, Facebook is just under $1 trillion market cap. I believe that they hit 1 trillion at one point, but currently they're 917 billion. Their price to sales is also very similar to Apple and Google, so they're all in line there in terms of price to sales. But if you take a look at the quarterly revenue growth, it's also 35%, so that's higher than Apple is. So Apple is 28, Facebook's 35, and Google's at 41. So relatively speaking, they're all similar price to sales, but Apple is relatively high in terms of Google and Facebook in terms of growth. So going forward, I'm more comfortable selling short Apple shares, or what we're going to do with options in this video is sell call credit spreads. And then for Google and Facebook, I'm going to be buying bull call spreads. Let's go through that whole process right now. I'm going to be doing $1,000 on Apple, and then I'm going to put $500 on Google and Facebook, or I might even do 1,000 on Google and 1,000 on Facebook, depending on how the options look for me as I go through them. All right, so I'm going to put on this trade for November 19th. I'm going to give it some time, and the first thing that I'm going to do is I'm going to sell call, and I'm going to open up a call option, and then I'm going to sell a call option that is going to be higher than the first call option. And basically what that means is I'm going to be collecting some premium, and what I'm going to do with that premium is actually I'm going to be opening up Google and Facebook trades. It's going to be very similar to the trade that I had on Tesla that made insane profits. You can watch that video in the description. Right now I'm going to go for an at the money option, so that's going to be $152, 152 and a half right here. Going to open it up. The delta is 0.42, the gamma is 0.06, and the theta is 0.08. What I'm really looking for is this delta right here. It is nice and high. That's actually a good thing, because in this scenario I'm trying to go short Apple, or I'm trying to sell delta. So when I go ahead and sell this, I'm going to be selling more delta than I'm going to be long. If you check it out, this is 42, right? I'm gonna go open up the 157.5. If I open this up, it's only 18. So I'm going to sell 42, but I'm going to be buying the 18. So I'm going to have a net position of negative 24 delta, or basically all you really need to know is I'm opening up a call credit spread. So now what I'm going to do is I'm going to switch off to buy. I'm going to buy this 157.5. And right now what I'm doing is I'm selling the 152.5. It's near the money, and that is for the purposes of collecting this $189. And then I'm going ahead and buying the 157.5. That's to close off my risk, because if you just go ahead and sell some calls, you're going to have unlimited downside, because if the stock continues to go up, you will continue to lose money. It's called selling naked calls, and I don't do that because it involves unlimited risk. So instead, I'm cutting off the potential to lose any money past $157.5 by buying this option right here. So the total credit right here says $1.23. So if I click continue, I'm going to be collecting about $123. However, this option position, this spread right here is worth about $500, because the difference between 157.5 and 152.5 is $500. But I do want to put enough money into Google and Facebook, and I at least want to buy 2 different bull call spreads. And I want to make sure that the amount of Apple that I'm selling in terms of this call credit spread will pay for Google and Facebook. So I'm going to probably open at least 2 or 3 contracts. If I open up 2 contracts, it's about $250. And if I open up 3 contracts, it's going to be $369. And I think that's going to be enough for me to open up 2 different positions on Google and Facebook. I'm going to enter 124, review the order, and place it. All right, so I just got filled and I collected $372 and I had a total collateral of $1,500. So now what I'm going to do is, because I'm short Apple, but I relatively want to be long Google and Facebook, is I'm first going to go over to Google and I'm going to open up Google shares. And I currently do have a position on Google. I sold some credit put spreads, but that's not really important. I made 45%, 100% return. If you want to have trades like this and follow along as I do them live, then you can always join the private Discord. Trade Google options. I'm going to be buying calls. I typically don't do this, but I'm going to make an exception because this is just an interesting idea I have. And again, it's going to be very similar to the risk reversal play that I had on Tesla, where I sold some puts at the 700 level and I bought some calls at the 990 level. Right now, buy call, I'm going to go ahead and buy the 3,000. Yeah, I want to be somewhere near the money. So I'm going to buy the, you know what? I'm actually going to go closer to the money. I'm going to buy this one right here. I'm going to buy 29.85, and then I'm going to sell the 29.90. So this is going to be a 500 spread. It's going to cost me $230. This is a call debit spread. I'm fine with that because relatively speaking, Google is a better buy than Apple based on the video that we watched in the beginning and also based on my analysis. I'm going to go for 2.5. Unfortunately, I may have to pay $250. So I just got filled for $250. And in this spread, what can basically happen is if Google closes above $290 or even at $290, I'm going to end up making $250 because this position right here is a total of a $500 spread. However, the total cost to me was $250. So in this scenario, the maximum amount of money I can make is $250 because I can actually double my money. It can go up for a total profit of $500. However, I paid $250, so 500 minus 250 is $250. In this spread here, I can actually double my money. Now, the next thing that I want to go for is Facebook. Now, Facebook is a stock that I really like. Now it's called Meta Platforms. I'm actually going to take a look at Facebook's chart because maybe I won't have enough money to buy an at the money call credit spread. Because we collected $372 and we just spent $250, we only have $122 left. I want to make sure that this trade still makes sense and I can spend around $122 for it. So the moving average right here for the past 50 days for Facebook is $347.34. And I do think that Facebook can again trade for $347. So for this spread right here, I will go slightly out of the money. All right, here is Facebook's beautiful options. Facebook is currently $335 per share. Again, I'm going to go for November 19th. The reason for it is because I want to give enough time for this play to play out, because otherwise, if I go for a weekly play, well, not much could happen in a single given week. So when you're actually buying options, it's better to go for something a little bit farther out in terms of dates. Now, for buying Facebook options, we're trying to spend about $122. I will spend up to $150. Let's see what what we can make happen. And previously we said that we can see the stock going back up to $347.50. So looking at it right here, I think I'm going to go for actually $340. I want to be closer to the money and see if I can afford this. So I'm going to buy the $340 call option right now. And to finance it, I'm going to sell the $345, or in other words, not necessarily finance it, but to create a call credit spread. All right, cool. We're actually at $175. I have $122 to play with. So basically I'm going to use $50 of my own money to finance this play right here. I don't really mind putting 50 bucks into this play. I'm going to open up one contract and I'm going to put my limit price of $1.75. All right, so I got filled for $178. So basically the whole point of this play was to collect money from Apple and use that money to buy Google and Facebook bull call spreads, because I think on a relative performance scale that Google and Facebook will outperform Apple. And even in the worst case scenario, if everything decides to go up, I will end up losing money on Apple. However, I will make more money off of Google and Facebook. All right, so that was a fun experiment I had for the day. Pretty cheap in terms of capital required to make this play, and I think this idea is going to be a good one. But again, I'm not a financial advisor. I'm just a guy that makes YouTube videos and has a passion for option trading. Hope you enjoyed this video, and I'll see you in the next one.